Joining us right now from New York, Ivan Feinseth, the Chief Investment Officer at Tigris Financial Partners, and our guest host for this hour, Activate CEO Michael Wolff. Ivan, let me start with you. The first thing I look at for this quarter was I was really surprised to see cash was in a reasonably strong position where one might have expected it was at the end of Q3 with the combined two companies. But the cash flow burn of nearly $1 billion, the worst Tesla has ever suffered.
Well, I really don't think it's so much of a concern because they are in the capital investment mode because they're still ramping up the production of the Model 3, going to be building more gigafactories and ramping up the production of the solar shingles. So, I mean, this is a capital investment story. If you believe in the story, you want to see them invest capital into the company.
Right, but if you've got, I mean, I'm not good at math, but if they've got $3 billion and they burn through $1 billion a quarter, this isn't a pretty story a year from now unless they sell more stock or borrow more money or do something to weaken their balance sheet or dilute the shareholders.
Well, they're probably going to go back to the capital markets again sometime between the spring and the summer, as they have for the past 2 years, because manufacturing cars is a very capital-intensive business, and this is a company that's in its investment and build-out stage. They're ramping up the production of the next model, the Model 3. They're still building out their dealer network, even though that's not that capital intensive. And they're ramping up the production of the new solar shingles.
Yeah, as you mentioned. Michael Wolff, talk to me about what you see in this quarter for Tesla.
Well, a couple questions are going to be, first of all, how well have they integrated SolarCity? And what are the benefits going to come from the integration with SolarCity? Are they going to get at costs? Are they going to be able to sell more of the shingles? And then the second thing is some of the other services that they're talking about, whether it's ride sharing or autopilot, how quickly are those going to roll out? I mean, that is part of what people are looking for, is not just the equipment of moving the metal, but also other services that are going to be internet-based and technology-based.
Ivan, what's the biggest risk you think to the stock here? I mean, it certainly had a great run in the last, if you look at the stock price over the last year, it's not as exciting as it is if you look at the last 6 months or even 3 or 4 months. It's had a fantastic run here. What do you think the preeminent risk is for this business?
That there would be a softness in sales for the Model 3 and then overall a softness in all the vehicles. So the risk is that the public stops buying Teslas. But so far, demand has been extremely strong, and the delivery amounts have been really hampered by production and not by demand. And
well, let me push back on that. In the last 7 quarters, 4 of them have seen sequential declines in the revenues from vehicles sold. So it does seem that the Model S still selling, but you don't see, they sold fewer in the 4th quarter than they did in the 3rd quarter, for example.
I think the demand and the production is still strong, and I think there's still strong anticipation of the Model 3. The Model 3 will be the game changer for them because it moves them from somewhat of a niche high-end car maker to more of a mainstream car maker, and the number of Model 3s projected will significantly exceed those of the X and S together.
All right, I think Michael, the jury's still out as to whether or not they can sell enough Model 3s to become profitable. And so up until now, they've been a luxury car. Going forward, the question is whether or not they can enter into the mass market, especially now that the big automobile makers in the longer term are going to be in this business big time also.
Yes,
well,
I do agree.
To that, they've lost. I'm sorry, Ivan. Yeah, they've lost money on every sale. If they have the same net margins for the Model 3 as they had for the Model S, Michael, I would suggest to you if they make more than one car, making a lot of cars is going to be bad news for them, not good news.
No, that math is not correct. They do not lose money on every car.
Well, sure they do.
If you look at it, it's not like the cars cost they sell for $80,000 and cost $84,000 to make. They have a gross margin of over 22%. So,
right, it's a gross margin, but it's not the operating margin. There are other expenses that go with making a car, like R&D, SG&A.
Yes,
I mean,
but that's capital investment. So they're not losing money on the sale of the cars. If you look at the gross margin on sales for the big automakers, for Ford and GM, is that they're trying to get to 10%. The gross margin on the publicly traded retailers like AutoNation is also about 10%. So you put that together, that's 20. Tesla is actually exceeding that because they are both the manufacturer and the retailer. So they have a gross margin on the sale of the car of 22%. The losses are coming from the capital investment that they're investing in the build out of each model line, and now the Model 3, and the build out of Solar City's solar shingles.
To play devil's advocate on two aspects, as you mentioned, the model is very different in terms of who owns the dealers. So the gross margin is affected by that. But the operating margins, not the capital investment, but the operating margins, whether it's R&D, whether it's marketing costs, whether it's SG&A, that's why the company has never made a penny. So in fact, it's not profitable. But we can take these accounting discussions to another day.
Yes, no, I understand what you're saying.
Last question to you, Michael Wolf. Just Michael, when you look at this company, I mean, are you inspired by what the company makes and what they're doing? Or are you discouraged by their continued free cash flow losses and operating profit losses as well?
I mean, the big concern that anybody should have around this company is whether or not they're going to be able to long-term charge a premium for their vehicles, and whether or not, as they expand production, they're going to have enough margin in each vehicle to make money once they take account of their capital investments as well as their individual production and selling cost.
Right. And so, Ivan, let me give you the last word. I don't mean to interrupt so much. There's so much to chew on this name.
Well, as I'm saying, if they were losing money on the actual sale of the car, where the cost of goods to produce the car was greater than the sale price, that would be bad. But I think it's positive that they are investing in R&D, they are investing in marketing, and they are investing in the factory, and they are investing in the Gigafactory, because the biggest constraint of the electric car is battery technology. And they have invested in a number of technologies, such as battery technology, aluminum welding technology. So if you look at this ramp up, it's not unusual for a company to invest money, especially a capital-intensive business like auto manufacturing, and not make money for a number of years. But the demand there is still strong for the car. I think that there's not going to be really competition for between other electric cars. I think the competition will be between electric cars and gas cars, because still Tesla is not really an electric car. It's a high-performance luxury car that happens to have an electric drivetrain. So I think that people looking at the performance and the luxury and technology features is what's driving the purchase.
Ivan Feinstein, thank you very much from Tigris Financial Partners. We appreciate it. And Activate CEO Michael Wolf is going to stay with us because we got lots more to cover today. Michael, glad you're here. Well, staying on earnings, HP Inc. reporting sales past the estimates. I guess the analysts were wrong again. Demand for computers and printers help drive the company's growth. Sales up a little bit in extended trading. Revenues up just 3% on a year-over-year basis to under $13 billion for the first quarter. The company also giving a forecast for profit for the current quarter, again in line with analyst estimates. If you take a lot of credit with analyst estimates. All right, coming up, exclusive interview with ARM Holdings CEO Simon Segar's company beating Intel in the semiconductor market. Next, this is Bloomberg. In 2011, Apple co-founder Steve Jobs presented the City Council of Cupertino, California, with plans for a new ring-shaped campus. It was Jobs' last public event before he died. Well, Apple announced it's going to start moving employees to that giant facility, 2.9 million square feet. In fact, of course, they're not square, they're round. Look at that thing. The opening date had been set for 2015, but Apple faced budget overruns and delays. This amazing building cost about $5 billion, although that's just an estimate. Apple's actually never given us a dollar amount, but there's a 1,000-seat auditorium in the building, which will be named after Steve Jobs himself. Well, Apple, as I mentioned, is weaning itself from Intel, developing their own chips for Mac laptops. No longer Intel chips, but ARM Holdings chips, or at least using ARM's technology. It's a leading semiconductor firm selling designs and licenses to its chip architecture to many companies, Apple, Qualcomm, Samsung among them. It was bought by telecommunications giant SoftBank in a surprise deal for $32 billion. Joining us right now is the CEO of ARM Holdings, Simon Segar. Thanks for coming by. We appreciate it.
Good to be here.
How's life different under SoftBank?
Well, in some ways, it's not very different at all. We're still very focused on executing on our roadmap, working with our partners, developing next generation technology that's being used in all sorts of devices, from smartphones to tiny microcontrollers in refrigerators and washing machines. So in a lot of ways, it's business as usual for us.
And as you said, in some ways, in a lot of ways, what about the other ways? What is different?
Well, no longer being a public company, but part of a conglomerate, part of a public company, we're now really able to think in a much longer term about investments that we make, in new emerging trends for technology, how they're being used, and really spent a lot more time thinking about long-term strategy than we could before. So it's business as usual in terms of execution, but in parallel with that, we're thinking now, decades out in terms of how people will be using technology and what that will mean.
SoftBank has announced a big fund, the Vision Fund. It got a lot of attention from President Trump, or President-elect Trump, in fact, took notice of it and maybe even took credit for it. But I wonder what that means for ARM if that fund's going to go after semiconductors. Does ARM end up working with other semiconductor firms or semiconductor investments? What's the relationship going to be?
Well, the way SoftBank has operated is, there are some operating companies, there are a whole number of investments
Silos.
that they have, and typically those investments have been things which have helped grow the business as a whole. So my expectation is that that money is going to be put to work in a fund that will return value for the investors in it, that will be in technologies around the kind of things that we do.
You guys over the last, call it 10 years, have really captured the tiger by the tail when it comes to smartphones and had great success as that business has really grown. What do you see happening in the smartphone business right now?
Well, from a volume perspective of handsets, the growth rates have tailed off, but there's still a lot of innovation going on within handsets. The compute performance is going up year after year. We're a few years away from having 5G technology, which is going to enable much higher data rates coming into your handset.
What's your expectation of timing there?
Probably around 2020, 2021. Before that's a kind of mainstream technology, although people are obviously starting trials much earlier than that. So that's going to, I think, ignite new use cases, new ways in which people are using phones, new applications, and is going to keep the whole industry innovating.
Yeah, and as you look at this business and as it grows, I mean, do you expect that we're going to see, Intel, for example, has made so much at least commentary and some business around Internet of Things. And I wonder if you see that as a necessary thing to really jumpstart the semiconductor cycle again, because we're seeing longer periods between the sales of PCs, declining tablet sales, longer periods of time between the refresh of smartphones. And I wonder if there is a new driver on the horizon from your perspective.
Certainly when I talk to our customers, when I talk to the CEOs of semiconductor companies that we work with, there are many who are looking at the growth in the semiconductor content in cars and the growth of IoT as big drivers for their business in the future. At any one moment in time, there are industries that are maturing, there are other things that are taking off. And right now, those two sectors particularly stand out as ones that are driving innovation and the potential for future revenue growth.
Looking beyond that, I mean, talk to me about the relationship with Apple, and what is it like to work with a company like that?
Well, with any big successful company, your licensees are very demanding on the technology, want you to keep executing, want us to keep investing in our roadmap, and we have many companies like that, many customers like that.
When you look at the sort of plans for Intel in terms of and I keep mentioning Intel maybe because I just focused on the company so much and have for so long, but when I look at their big plans for capital expenditures, when I look at the fabs they're building and going down to unimaginably thin wafer sizes and so on, do you see that as your biggest source of competition because they're able to drive those CapEx dollars into that business?
Well, Intel is a significant customer of ours, and we're actually working with them on deploying some of that advanced manufacturing technology.
Co-opetition, maybe.
So that other licensees of ARM processors can go manufacture in their process.
Right.
So we've been working with them for some time on that. The overall semiconductor industry is pushing forwards on these very advanced geometries. That's going to enable more performance, it's going to enable better energy efficiency, so we can all have more and more powerful devices with us.
And in terms of when we look at those drivers and things, the other company, of course, that looms so large in the semiconductor business, and it's amazing that you guys have grown to where you are already, but Qualcomm, such a big company, but it seems to me that although for so many years they've fought off antitrust concerns, they're facing these antitrust challenges across all kinds of geographies. Do you think that Qualcomm's been a fair player when it comes to the way that they've licensed their technology and worked with their customers?
Well, I don't think it's really for me to comment on whether they've done that fairly or not. I mean, what I have seen, having worked with them for a long time, is they've invested a lot in technology R&D, invested a lot to bring these advanced wireless technologies to the market. Up to them how they go monetize it, but you can't fault them for the amount of R&D spending that they've done over the years.
Great stuff. Simon Segars, thank you very much.
Thanks a lot.
ARM Holdings CEO Simon Segars, appreciate your time. Well, coming up, the possibility of net neutrality rollbacks continue to attract attention. What can it mean to tech titans? We'll talk about that next. This is Bloomberg. All right, Verizon is thinking about 5G. We were just talking about that. The nation's largest wireless carrier is going to start testing 5G service in 11 markets in the first half of this year. Those faster connections will help Verizon offer internet speeds competitive with cable TV. Now, while 5G isn't expected to be commercially available until 2020, as we just said, Ericsson, Qualcomm, Intel, and ARM, of course, all looking at that business, expected to invest $20 billion in that business. All right, the new Republican majority in the U.S. could mean big changes in standing net neutrality laws. This rule bars internet service providers from slowing or blocking traffic. That net neutrality rule was opposed by FCC's new chairman, Ajit Pai. He's been a longtime critic of the rule. He's been on the show many times talking about that. But the implications are massive, or could be. Activate CEO Michael Wolff still with us. And Michael, I think this is such an interesting issue. Every time we report on this and try to learn more about it, I get inundated with people on Twitter and so on saying, you guys don't know anything about this. You're completely wrong on how this. It's confusing, I think, to a lot of people what this means. So how do you give me your metaphor for idiots like me?
I think that the way to think about this is that typically when you have deregulation, it leads to innovation. The irony here is deregulation could actually, in a lot of ways, squelch innovation. And here's why, which is the ISPs could really throttle back on traffic or charge some of the companies that are coming onto the web. So you would see new companies, like there's a company called NextVR, or some of the new esports providers, as well as even companies like Snap. They wouldn't have made it in an environment where they had to pay to be carried on the pipes of the ISPs. The biggest companies, Netflix and Google and Hulu and others, they can afford to pay. They're well positioned. So this really does put a challenge on innovation in the technology business.
What the rich call regulations, the people call protections, right? I mean, that's sort of they're different sides of the same coin. And I wonder, when you look at these rules, it's almost as if you're comparing it. We might as well stick with the highway metaphor. The width of the road, actually, standardization there does help innovation. And it sounds like you're saying the same thing is true in terms of even access, right, or free access to the pipes. But doesn't that put a burden, therefore, on the provider of the pipes, of the ISPs, of the Verizons and AT&Ts of the world?
The providers of the pipes, they have the opportunity, first of all, to sell other services. They have been able to increase their pricing. They're able to provide more bandwidth. And so the challenge is really going to be, can they keep up with expanding bandwidth, and can they do so in a way that maintains a free and open internet? Interestingly, the largest technology companies who really don't have anything to worry about are also for net neutrality. They're against any changes because they want to see innovation. So ultimately, there's one thing that the legislation will say, which is you can charge everybody. The other side of it is what the ISPs are actually going to do. And I actually believe the ISPs are not going to try to throttle traffic, or not going to try to charge companies, because they have a vested interest in there also being a lot of innovation. They don't want to just bet on the companies that are the most important companies today on the internet. They also want to be open to the next wave of companies.
20 seconds here. Is this conversation academic because you're going to have Republican control over the FCC, whether we like it or not?
I don't think it's academic, because I really think it comes down to not what the legislation is going to say, but what companies, the ISPs and the largest companies and the smallest companies, are going to be able to do.
All right, Michael Wolff. Michael Wolff is the Activate CEO. He's also our friend who's going to stay with us for the rest of the show. We appreciate that. We are just moments away from the start of Tesla's latest earnings call. What's Elon Musk going to say? We'll tell you in just a little bit. And also, we have a command on the Bloomberg terminal called TV Go. You hit TV Go, and there pops up Watch Live on Bloomberg TV. You can watch us live, of course, but you can also go back and see previous interviews and dive into any of the securities or Bloomberg functions we talk about on the show. And you can become part of the conversation by sending us instant messages during the show. Distract me, hit me up, IB me if you've got a Bloomberg terminal, and you can check out TV Go. This is Bloomberg. This is Bloomberg Technology. I'm Corey Johnson, and Tesla shares trading up in after hours earnings call just getting underway, but CEO Elon Musk is promising that the much hyped mass market Model 3 is on track, not just for initial production in July, but for volume production in September. That's right, Q3. But let's focus on the solar side of the business. It's the first earnings report that includes the impact of the Solar City acquisition. Bloomberg News energy reporter Mark Chidek joins us right now. Michael Wolff is still with us. Mark, the Solar City was appropriately named solar because it was going nuclear in terms of burning through cash. What's the impact now that these companies, both these cash burners, are together?
Well, it seems like what Tesla is saying in their latest report is that they're really focused now on trying to get Solar City cash flow positive.
Solar City said that before, and the cash flow burn got worse.
Yes, well, what they claim now is that the solar unit contributed $77 million to Tesla's bottom line for the quarter. What they're really trying to do now...
$77 million in terms of operating profit?
No, just in cash.
In cash,
yeah.
Okay.
I mean, I think what they really want to do is they want to get the cost down significantly because they see a lot of headwinds in the solar installation business. Utilities are pushing back in terms of offering incentives. A tax incentive that the federal government is offering is going to roll off in a couple years. So Solar City is sort of preparing for those losses of incentives.
Yeah, Michael Wolff, when you look at a sector like this where you've seen every company left, right, and center face plant,
yes.
It was surprising to see an acquisition, especially when the CEO of the acquiring company is the largest shareholder of the acquired company.
It was a shotgun marriage in a lot of ways. I mean, the fundamental question about Solar City is one of price versus performance, which is, can these solar shingles, do they perform better than other solar panels, and can the same type of shingle be produced much cheaper somewhere else, like in China? We've already seen China take the lead on producing inexpensive solar panels. So from my perspective, the question is whether or not, the existential question is whether or not this company continues to have a superior product that people will pay for.
Well, indeed, and when someone's willing to sell you $1 for 50 cents, it's good to be the buyer. It's not always so good to be the seller. Michael, do you have solar in your home back east?
No, I don't.
Because I put solar in my house that I built here in the Bay Area because it was so cheap and there were so many fantastic subsidies available. But to that point, Mark, I mean, the subsidies might not be as available under a Trump administration.
No, I mean, that's a little unclear. I mean, some people think that the subsidies that remain now at the federal level will stay there because they eventually roll off over time. But at the state level, you're seeing a lot of pushback from utilities offering subsidies to folks who want to get rooftop solar on their homes.
And to that, I mentioned all that happening to the entire sector. Can Tesla change its business model? I mean, it's the same management, right?
I think what they're trying to do is really focus on going from a model where they lease solar systems and they get this revenue drip over time to where they sell a system for cash, and that gives them a lot more revenue up front. So they talked a bit about that in their earnings release this afternoon, that they're transitioning to that sort of model. They doubled percentage-wise the number of solar systems they sold for cash for the quarter.
I should point out some breaking news here on Tesla. Mike, I want to get your reaction to it without specifics, but the CFO of Tesla apparently is leaving at this critical time for the company. CFO Jason Wheeler leaving Tesla. Former CFO is going to come back. Jajit Athwa is going to return as CFO. We don't know how long. But that's a big change here, Michael. When a CFO leads a company, it's going from a critical position where it's making 50,000 cars to expected to make 5 or 10 times that I shouldn't say 10, well, about 10 times that over the next couple of years. That's a pretty big change. What's your reaction?
I don't know the specifics, but a lot of time what it really means is tightening up operating performance and specifically focusing on margins. And usually that is one of the reasons why people make this change of a CFO, especially when you're going back to the previous CFO. So I think we're going to see, this is what the earlier conversations have been today about, which is margins. Can these guys, are these guys going to lose money on every car that they sell? Or is this going to be a business where they truly are able to charge a premium and earn money?
Right, obviously they haven't made a dime yet, but we wish them luck. Activate CEO Michael Wolff staying with us, and Mark Chidek, thank you very much. I appreciate your walking all the way over, across from the newsroom, over here to the TV set. Hard work indeed. All right, also out with earnings after the bell. FitBit, revenue for the struggling wearables maker was down 19% year over year. Shares trading up. I don't know what that means, but in after hours, actually, it looks like now they've turned down. Selena Wang joins us right now. She covers FitBit for us for Bloomberg. Michael Wolff's still with us, even though I just thanked him and like I was getting rid of him. Selena, tell me about the quarter. I haven't looked at it yet. What does it say?
Corey, as you mentioned, the shares are a little changed. That's because Fitbit already dropped the bomb earlier last month when they pre-announced that they were going to miss earnings. They were going to be cutting 6% of the workforce. But as you said, revenue dropped almost 20%. They already had the bar set very low, but even then they barely met those very low expectations and missed on some metrics as well. And their outlook also was not pretty.
Yeah, big decline in sales here, but they still seem to command a lot of market share. Activate CEO Michael Wolff, when you see a company like this that is sales down, absolutely, but margins are still very strong even though they're consumer electronics. Competitors are leaving the space, maybe leaving them a little more runway. And I wonder what you make of that when you look at this business with declining revenues but sustainable margins and competitors falling away.
Well, first of all, the product is superior because it's simple, and people want to use it because it's simple. Second of all, like every other consumer electronics company, they need a next wave of innovation. And so when they come out with a new product, they give consumers a signal that it's time to buy. So I do expect, as the other competitors have gone away, as the more expensive wearables are really not as interesting to consumers, I think this company is going to continue to grow and go back to a growth trajectory.
Selena, what's the how are they feeling on the call? Are you sensing that optimism?
Mm-hmm. You know, the call is still ongoing. James Park is obviously optimistic as ever. He's saying that they're going to be looking to new form factors. As Michael mentioned, they really need to innovate, come out with new products. Even though their product is simple, I think that in Q4 really showed that consumers are looking for something that's a bit more sophisticated. And that's why they're focused on integrating some of their acquisitions of Pebble, Vector Smartwatch, and Coin so that they can come out with a new product to generate more demand. Another interesting part was James Park again emphasized his push for his digital health strategy. They want to continue to integrate into the healthcare community. He gave an example of their data feeding into one of Medtronic's glucose monitors so that that data is being directly integrated into that. And he definitely wants to get more revenue from those types of partnerships.
Right. James Park, of course, is CEO of Fitbit. We couldn't be more sophisticated because we've got Michael Wolff, we've got Selena Wang. That's pretty sophisticated right there. Thank you, guys. We appreciate it. Pleasure. All right, I should also mention Square out with earnings after the bell. The company topped sales estimates for the fourth quarter. Our own Selena Wang will be sitting down with the Square CFO tomorrow. Sarah Fryer, not our Sarah Fryer, but Square's Sarah Fryer. That's happening on Thursday. You can catch it right here on Bloomberg Technology. Well, coming up, $30 billion in gaming mergers, acquisitions, and investments in the last year alone. $30 billion. So what do we expect from that industry in 2017? We're going to dig into the gaming investment space. This is Bloomberg. Well, the gaming industry gearing up for next week's developers conference. The Game Developers Conference is a big deal here in San Francisco, and a big deal for the business, a big business. $30 billion last year in mergers, acquisitions, and investments. Of course, investors looking for more this time around. Joining us right now, Maha Ibrahim, the general partner at Canaan Partners. Glad to see you here.
Hi there, how you doing?
Glad to see you anywhere. Can you explain to me how this business works from the app side? Kabam's a company you've worked with, and I don't really understand the business model. It's my understanding that apps are a crummy business model, but they worked on this Marvel game that my kids love, and I just wonder, how does that business work? Like, let's do like a unit breakdown. You sell this to whom, for what, and how's it work?
So at Kabam and Canaan, we've been looking at transformational shifts at the platform level. And the platform level is a shift like Facebook did when they went into mobile that will drive massive amount of downloads and massive amount of app installs. In the case of Kabam, the secret sauce there, the key that we unlocked was really going around and getting these licenses for IP, like we did with Marvel, and like we're going to be doing with Transformers in the springtime. That's going to be the draw that pulls in the app installs. And from there, it's all about delivering a good game that is highly monetizable. It's legit
a good game. And in the same way that Tetris isn't about a license, it's got to be a good game.
That's right.
This has been by a source, well, me and two smaller young ladies. It's a good game.
Right. It is about building a good game, but it's not just enough to build a good game.
Right.
And that's why you've seen a lot of games companies fail. They haven't had that pull. They haven't had that reason why people would download. At the same time, it's a good game that has longevity to it, that there are multiple levels within the game that keep people coming back and coming back and coming back. So it's about the initial install, and it's about the longevity.
All right, so you get the install, they love the Wolverine, they love the Hulk, they download the game. But there's a license fee there, and that license fee surely is not small. There are no dopes over there at Marvel. But I wonder, again, back to the unit cost, like where are the economics in this? Where's the revenue come from? How's the repeat revenue happen?
That is the key to building a great game. It really is about unlocking the monetizable units. In their case, it's about the virtual goods. In most cases in the App Store, it's about virtual goods. And that's why you see games being by far the largest revenue driver within the App Store for Apple.
Is that also a whale business where you've got 5% of the users paying 90% of the revenues?
Yes. There are very few consumer companies, consumer media companies, that don't generate their businesses from that top 10, 20%. And we focus on that at Kabam. Most gaming companies do that. And I think you'll see that as we shift to the next platform, which is eventually going to be virtual reality, if and when that comes.
I want to find those whales. I want to meet the person who's spending, 50 grand a year playing the Kim Kardashian game. I sort of want to meet that person. That person exists out there somewhere. But to that point, I mean, what's the special sauce? I mean, you suggested the license is a special sauce. I would say to you, if that's all it is, that's not very special.
It is very special because some of these licenses are extremely valuable. In the Marvel case, obviously. In the Transformer case, they obviously are.
And you've
as well.
locked that down across all games.
We have Kabam has locked that down across certain IP within Marvel and Transformers. And then on the other hand, there are fantastic games that have been developed that don't have third-party IP and that can be incredibly valuable. It's just that right now, we saw
that with Candy Crush and
exactly.
Right?
There is a huge concentration within the successful gaming community, and they have locked down that top 10, top 15 grossing in the App Store. It is very difficult to penetrate that now because games are such a competitive ad sales market. It's just highly, highly expensive to buy those installs now.
So from your role as a venture capitalist, you find these guys, you make investments with them, you help them grow the company, you help them not screw it up, hopefully, or inspire the genius that they come with it naturally. But how do you try to find other investments of this sort?
Gaming is an incredibly difficult market. And I'll tell you, the Kabam story at Canaan was one that was not short. It is a story inside a story inside a story inside a pivot. The relationship with the entrepreneur was incredibly important. That level of trust that we had with the entrepreneur, with Kevin Chu, the CEO, whom you've had on many times, was frankly a key part in continuing on with the company until they reached that success point, which they did. In gaming generally, it is incredibly difficult from the get-go to predict a success, which is why in most cases, game companies only get venture financed once they have reached some sort of success metrics.
It's a hit-driven business.
It is a hit-driven business, but unlike the movie business, it's not one that dies off after a weekend of success. It can continue for years and years and years, like in the Kabam franchise case.
Do you need, therefore, if it's a hit-driven business, to sort of use the venture capital phrase spray and pray? Would lots of releases because you don't know which one's going to take? Or conversely, do you have to stick to your knitting and focus on? I'm over-metaphorizing here, but do you have to stick with a couple of games to really make sure they're good because they need to be that much better than the average game? That's
what has changed in the market over the last several years as the App Store has become increasingly concentrated and congested. Really, you need those big, heavy franchises, those Marvels, those Candy Crushes, any of the ones in the top 10. They've stayed in the top. Whatever. They've stayed in the top 10 for years now. So it really is about building the mega hit, not assuming that you can build 10 okay hits because you can't afford anymore to.
Is it really quick? Is that because development costs have gotten so high?
It's because development costs have gotten high. It's because install costs have gotten high.
Right.
And that's why the leverage of the third-party IP can come into play. It can artificially bump you up in terms of the app installs because that property, the Marvel property, the Transformers property is so exciting for users.
Which in install cost suggests marketing. Marketing is why whatever you're doing on your phone, you're getting a hit up for ads, for games. Great stuff. Maha Ibrahim, always a pleasure from Canaan Partners. All right, coming up, Snap continues its roadshow looking to make the case to investors that its stock's a good bet despite the valuation. How's the street reacting? We'll tell you. This is Bloomberg. Well, back to the story of the moment. Tesla's earning call ongoing. CEO Elon Musk announcing surprisingly that CFO Jason Wheeler is leaving the company. Listen to what he said.
First of all, I'd like to announce that our CFO, Jason Wheeler, has decided to leave Tesla in April, so at sort of end of next month, to pursue opportunities in public policy. Jason will be replaced by Deepak Ahuja, who is Tesla's first CFO and worked for the company for more than 7 years before stepping away in 2015.
All right, Wheeler said in the call he's stepping down to pursue public policy projects. Staying with social media, Snapchat's parent company, Snap, in New York. Investor Roadshow continuing tomorrow, Boston, then Monday right here, talking to investors in San Francisco. The IPO is slated for next week. Investors asking about questions about growth amid a rivalry with Facebook and Facebook's Instagram. Still with us, Michael Wolff of Activate. Michael knows the media business quite well. He's a former board member of Yahoo and president of MTV Networks. Michael, this is a negative gross margin business whose customer growth is slowing dramatically. And yet they're going out at an extraordinarily high valuation compared to the S&P 500, about 2x. These guys are going out, it looks like, trying to do about 17 times sales with no profits in sight.
There are three big questions about Snap. First of all, are they going to be able to expand their user base beyond millennials, because it's very much a millennial thing right now? Second of all, how are they going to defend against their competitors, and specifically Facebook, cloning or copying some of their features? And then third of all, are they going to be able to find revenue that goes beyond advertising on Discover? And I'm actually very upbeat about what they can do. I think that on expanding beyond millennials, it's like all of these companies. Facebook began with a small core of college students. I think that Snapchat will be able to dramatically expand beyond those core millennials. It's not just my 18-year-olds are going to use it, but lots of other people. In terms of their ability to compete with Facebook, yes, Facebook, Instagram, they're copying, and WhatsApp, they're copying a lot of the same things, but nobody's going to use those companies' filters. They're unique to what you can do on Snapchat. And then third of all, revenue, yes, already they're showing that they have other revenues. They have sponsored filters. There's a lot more of the site, and also they can add a lot more services. Their chief revenue officer, Jeff Lucas, is incredibly talented. We work together at MTV, and I have a lot of confidence that this is a business and a franchise that's going to continue to grow.
Just 30 seconds left, Michael, but how important is a youth market to advertise in when today's youth, if you will, doesn't attach to a brand the way they did in earlier generations?
You still need to reach them. You still need to get them to make decisions about everything from what video game they'll download to what movies they'll see. And they may not be as brand focused, but they're certainly focused around what they're going to do. And they're extremely valuable to advertisers, because the question isn't just what they're worth to you today, but what they're worth to you 1,500 days from now, when they're going to be making other purchases like buying a car and others. So I think there are very few places where you can reach millennials like this, and Snapchat is in a unique position to do so.
Michael Wolff, thank you very much. Michael Wolff is the CEO of Activate and was with us a whole hour, and I, for one, am grateful. Thank you.
Great to be here.
All right, one last thing. Sticking with social media, Instagram announcing another update. The photo sharing social network will let users put multiple photos and videos on a single post. The feature essentially creates something like a slideshow, or I don't know, just a bunch of pictures that go in a single post. Kind of like stories, a little different from stories. Kind of like Snapchat, a little different from Snapchat. That's just kind of this new feature from Instagram. So check me out on the gram. It's Corey John. I'm at Corey TV on Twitter as well. And tomorrow, you got to check out Sarah Friar, the Square CFO, on Bloomberg Technology. This is Bloomberg.